Disclaimer.
What if I told you that a single Supreme Court case happening right now could send gold prices past $5,000 an ounce? Not because of inflation, not because of war, but because of something far more fundamental to our financial system. On January 21st, 2026, the Supreme Court heard arguments in a case called Trump versus Cook. You probably didn't see it trending on social media. Most Americans have never heard of it. But Goldman Sachs is watching this case so closely, they have issued a warning that gold could hit $5,000 if the outcome goes a certain way. Think about that for a moment. The most powerful investment bank on Wall Street is telling clients that one Supreme Court decision could drive gold up another 16% from current levels. Here's what should grab your attention. This isn't just another political squabble. This is the first time in 112 years that a sitting president has tried to fire a Federal Reserve governor. Let me put that in perspective. The Federal Reserve has existed since 1913. Through two world wars, the Great Depression, the stagflation of the 70s, the financial crisis of 2008, and the pandemic, no president has ever attempted what's happening right now. We've seen presidents complain about the Fed. We've seen them pressure Fed chairs in public. But actually firing a Fed governor? That boundary has held for over a century, until last August 2025. President Trump fired Lisa Cook from the Federal Reserve Board of Governors. The official reason? Allegations related to mortgage fraud claims. But if you think this is really about mortgage fraud, you're missing what's actually at stake here. Lisa Cook is one of 7 governors who sit on the Federal Reserve Board. More importantly, she's one of the 7 voting members of the Federal Open Market Committee, the group that sets interest rates for the entire United States economy. Every time you hear about the Fed raising rates or cutting rates, that decision comes from the FOMC. Right now, the board has a slight majority that doesn't always align with Trump's preferences on monetary policy. If Lisa Cook is removed, Trump gets to appoint her replacement. That gives him a 4-3 majority on the Board of Governors. You might be wondering why this matters to your retirement account or your gold investments. Here's the connection that Wall Street has already figured out. The Federal Reserve's power comes from one critical factor: independence. When markets believe the Fed makes decisions based on economic data rather than political pressure, people trust the dollar. They trust Treasury bonds. They trust that inflation will be managed appropriately. But what happens when that independence becomes questionable? History has already shown us the answer, and it's not pretty. According to Bank of America's commodity research team, threats to Fed independence are now the #1 bullish factor for gold prices. Not geopolitical tensions, not central bank buying, threats to Fed independence. Let me show you what's already happening in the market. Gold prices have surged more than 50% during 2025 alone. We're currently trading above $4,300 per ounce. 5 years ago, gold was around $1,800. Think about your own portfolio for a moment. If you owned gold 5 years ago, you've more than doubled your money while the stock market has been choppy and Treasury bonds have been losing value as yields rise. But here's what most people don't realize. This isn't just a bull market driven by traditional factors. The smart money, the institutional investors who move billions of dollars at a time, they're repositioning based on something specific. They're preparing for a scenario where Fed independence is compromised. JP Morgan released a research note in December 2025 that should make every investor pay attention. They raised their gold price forecast specifically citing the Trump versus Cook case and what they called structural risks to monetary policy credibility. Bank of America went even further. They increased their average gold forecast to $3,049 per ounce, with a short-term target of $4,000. But the most striking forecast came from Goldman Sachs, $5,000 per ounce if private investors start diversifying away from bonds, stocks, and the dollar into gold as Fed credibility collapses. These aren't gold bugs or conspiracy theorists making these predictions. These are the largest investment banks in America. Have you noticed what's been happening to your purchasing power over the last few years? The official inflation numbers might say 3 or 4%, but your grocery bill, your rent, your health insurance premiums tell a different story. Now imagine what happens if the entity responsible for controlling inflation, the Federal Reserve, loses its ability to make decisions independently. If markets start to believe that interest rate decisions are being made based on political considerations rather than economic data, we enter territory that the United States has never experienced in modern times. The closest parallel would be countries where central banks lost independence and currency crises followed: Turkey, Argentina, Venezuela. But we're talking about the United States dollar, the world's reserve currency. Here's where the mechanics get really important. The Federal Open Market Committee makes decisions by vote. Currently, there are 7 board governors, 5 regional Fed presidents, and the chair who breaks ties if needed. But the board governors have permanent votes, while only 5 regional presidents rotate voting positions. This means the Board of Governors holds enormous power. If Trump succeeds in removing Lisa Cook and appointing someone aligned with his policy preferences, he doesn't just get 1 vote. He potentially shifts the entire balance of power on interest rate decisions. The next question becomes, what if Jerome Powell is next? The Department of Justice has already opened an investigation into Powell's conduct. What looked like an isolated incident with Lisa Cook now appears to be the opening move in a much larger strategy. Let's talk about what this means for ordinary Americans trying to protect their wealth. You've worked your entire life building a retirement account. Maybe you've got money in stocks, bonds, a 401k. You're counting on the system working the way it's supposed to work. But that system depends on trust. Trust that inflation will be controlled. Trust that the dollar will hold its value. Trust that monetary policy decisions are made by experts analyzing economic data, not politicians trying to goose the economy before an election. When that trust starts to crack, institutional money moves, and institutional money has already started moving into gold. The data coming out of the World Gold Council tells us something remarkable. Central banks around the world have been buying gold at record levels, over 1,000 tons annually since 2022. Think about what that means. These are the institutions that manage the reserve currencies for entire nations. They're diversifying out of dollars and into gold at a pace we haven't seen in decades. For the first time since 1996, gold now comprises a larger share of central bank reserves than United States Treasury bonds. Read that again. Foreign central banks, the entities that have traditionally been the biggest buyers of our government debt, are now holding more gold than Treasury bonds as a percentage of their reserves. This isn't happening in a vacuum. These central banks have access to information and analysis that most individual investors never see. They have economists, strategists, and intelligence briefings. When you see this kind of coordinated behavior from central banks across different countries with different political systems, they're responding to something fundamental. They're responding to a loss of confidence in the dollar-based system. And the Trump versus Cook case is accelerating that loss of confidence because it strikes at the heart of what makes the dollar trusted: an independent Federal Reserve. Here's what you need to understand about gold in this environment. Gold doesn't pay dividends. It doesn't generate cash flow. You can't deposit it in a bank and earn interest. So why is institutional money piling into gold right now? Because gold is the only major asset that doesn't depend on any government, any institution, or any promise to maintain its value. When you own gold, you own something that has been recognized as valuable for thousands of years across every civilization. According to the Bank for International Settlements, gold is considered a Tier 1 asset, meaning banks can hold it as high-quality liquid assets without any haircut. That's the same classification as cash and government bonds. But unlike cash or bonds, gold can't be printed or defaulted on. The Supreme Court hearing on January 21st was just the beginning. Over the next 6 months, we're going to see this case play out in ways that will fundamentally reshape American monetary policy. The justices will decide whether a president has the constitutional authority to fire a Fed governor for reasons unrelated to specific legal violations. If they rule in Trump's favor, every future president will have that power. The Fed, as we've known it for over a century, changes overnight. If they rule against Trump, we might see a constitutional crisis where the executive branch refuses to accept the court as authority on this specific issue. Either way, the uncertainty alone is enough to drive investors toward assets that don't depend on institutional stability. Goldman Sachs didn't pick the number $5,000 randomly. They're modeling what happens when private investors, not just central banks, start to question whether dollar-denominated assets are as safe as they've always assumed. Think about your own situation. You're planning for retirement. You're trying to preserve purchasing power. You're watching the news and seeing unprecedented political battles over institutions that used to be considered sacrosanct. What's your move? Do you keep all your wealth in assets that depend on faith in government institutions? Or do you start hedging with something that exists outside that system entirely? That's the question that millions of Americans are going to be asking themselves as this Supreme Court case unfolds. And the answer they give will determine whether Goldman's $5,000 forecast becomes reality. Let's talk about the money that's already moving. When Bank of America updates their commodity forecasts, they don't do it casually. These reports go to pension funds, sovereign wealth funds, and family offices managing billions of dollars. In their most recent quarterly outlook, Bank of America raised their gold price forecast by 6% to an average of $3,049 per ounce. But here's what matters. They didn't raise it because of jewelry demand or mining supply disruptions. They raised it explicitly citing Trump's attacks on Federal Reserve independence. That's not buried in footnote 73 of the report. That's the headline explanation. The short-term target they're giving clients? $4,000 per ounce. We're already at $4,300, which means Bank of America is telling institutional clients that current prices are justified by the Fed independence risk alone. Now think about what it takes for a major bank to put that in writing. Bank of America has relationships with the Federal Reserve. They're regulated by the Fed. They depend on Fed lending facilities during market stress. For them to explicitly state that presidential attacks on the Fed are driving gold prices higher, that's not a small statement. That's them telling their clients that this risk is real, it's material, and you need to position for it now. According to their commodity research team, the structural threat to Fed credibility has become the dominant factor in gold pricing, surpassing traditional drivers like real interest rates and dollar strength. When was the last time you saw a major bank say that political institutional risk mattered more than interest rates for a financial asset? Goldman Sachs went even further in their analysis. They published a scenario modeling piece in December 2025 that should make every investor uncomfortable. Their base case has gold continuing higher as central banks diversify, but their tail risk scenario, the one that gets gold to $5,000, hinges on something specific: private investors starting to diversify away from bonds, stocks, and the dollar into gold as Fed credibility collapses. Let me break down what that means in practical terms. Right now, most American wealth is stored in three places: stock portfolios, bond portfolios, and cash or cash equivalents like money market funds. All three of those depend on faith in American institutions. Stocks depend on economic growth and corporate earnings, which depend on sound monetary policy. Bonds depend on the government's ability and willingness to pay its debts, which depends on the dollar maintaining value. Cash depends directly on the Federal Reserve managing inflation properly. What if that faith starts to crack? Goldman's model shows that even a modest shift, just 5 to 10% of private investment capital moving from traditional assets into gold, would overwhelm the physical gold market and send prices dramatically higher. Here's why. The total value of the global stock market is around $100 trillion. The bond market is another $130 trillion. If even 5% of that combined wealth decides to hedge by buying gold, we're talking about $11.5 trillion chasing a gold market that's currently valued at around $16 trillion total. But here's the catch. Most of that $16 trillion in gold is not available for purchase. It's in central bank vaults, in jewelry that people aren't selling, in industrial applications. The amount of gold actually available for investment at any given time is a fraction of the total. That's what creates the price explosion Goldman is modeling. You might be thinking this sounds theoretical. Let me show you what's already happening in the data that proves institutional money is moving right now. Exchange-traded funds that hold physical gold, the vehicles that allow investors to own gold without storing bars in their basement, saw record inflows during the third quarter of 2025. $26 billion in a single quarter. To put that in perspective, that's more money flowing into gold ETFs than the entire previous year. Total assets under management in gold ETFs now stand at $472 billion. That's not retail investors buying gold coins at local shops. That's pension funds, hedge funds, and wealthy individuals clicking buttons to reallocate their portfolios away from traditional assets and into gold. The World Gold Council tracks these flows meticulously, and their most recent quarterly report shows something unprecedented. For 3 consecutive years now, since 2022, central banks have been buying over 1,000 tons of gold annually. A ton is about 32,150 troy ounces. So we're talking about central banks buying more than 32 million ounces of gold every year. At current prices above $4,300 per ounce, that's over $137 billion in annual purchases by central banks alone. These aren't speculative traders trying to make a quick profit. These are the monetary authorities for entire nations making strategic decisions about how to store their country's wealth. And they're voting with their wallets, moving money out of dollars and into gold. Here's the statistic that should stop you in your tracks. According to the International Monetary Fund's quarterly reserve data, gold now comprises a larger share of global central bank reserves than United States Treasury bonds for the first time since 1996. Think about what that represents. For nearly 3 decades, foreign central banks held more of their reserves in our government bonds than in gold. That was the foundation of dollar dominance. Countries would sell us their goods, we'd pay them in dollars, and they'd recycle those dollars back into treasury bonds. That's how we financed our deficits, our military, our entire way of life. But that cycle is breaking down. Central banks are still accepting dollars for trade, but they're not holding those dollars as treasury bonds anymore. They're converting them to gold as quickly as they can without crashing the bond market. Why would they do that? Put yourself in the position of a central bank governor in China or India or Saudi Arabia. You're holding hundreds of billions of dollars in reserves. Your job is to preserve the purchasing power of those reserves for your country. You're watching what's happening in Washington. You're seeing a president try to fire Federal Reserve governors. You're seeing investigations into the Fed chair. You're hearing prominent American politicians talk about the need to bring the Federal Reserve under more direct political control. What's going through your mind? You're thinking that the rules of the game might be changing. You're thinking that the dollar's value, which depends on the Fed managing inflation and maintaining stability, might become subject to political whims rather than economic necessity. So you start diversifying, not all at once because you don't want to trigger a panic, but steadily, quarter after quarter, you're buying gold. Let's look at what the market itself is telling us about Fed independence risk. The dollar index, which measures the strength of the US dollar against a basket of major foreign currencies, has weakened to 98.14. 5 years ago, it was trading above 103. That might not sound like a huge move, but for currency markets, it's significant. A weaker dollar means our purchasing power is declining relative to other countries. It means imports cost more. It means when you take that European vacation you've been planning, your dollars don't go as far. According to Federal Reserve data, the dollar's share of global foreign exchange reserves has fallen from 62% in 2020 to 58% today. That's 4 percentage points in 5 years. At this rate of decline, by 2030, the dollar could be below 50% of global reserves for the first time since World War II. The bond market is flashing warning signs too. The yield on the 10-year Treasury note has widened relative to inflation-protected bonds, a signal that investors are demanding higher compensation for inflation risk. When bond investors start pricing in higher inflation expectations, that's them telling you they don't trust the Fed to keep inflation under control. And why would they? If the Fed's decision-making process becomes politicized, if interest rates are set based on what is good for the president as approval ratings rather than what is good for price stability, inflation becomes unpredictable. Treasury bonds only make sense as investments if you believe inflation will remain low and stable. Take away that assumption, and suddenly 10-year bonds yielding 4 or 5% look like terrible deals. You're locking in a fixed return for a decade in an environment where inflation could accelerate at any time. Here's where it gets really interesting for gold investors. JP Morgan's commodity strategists published a deep dive analysis in late 2025 that connected all these dots. They started with the obvious point. Gold typically rises when real interest rates fall, because the opportunity cost of holding gold decreases. But their analysis showed something more nuanced happening now. Even as nominal interest rates have stayed elevated, gold has been rising because the risk premium investors are demanding has increased. What's a risk premium? It's the extra return you need to be compensated for uncertainty. In normal times, US Treasury bonds are considered risk-free assets. But if the Fed's independence is compromised, Treasury bonds aren't risk-free anymore. They carry political risk. And when political risk enters the equation for what used to be the world's safest asset, investors need an alternative store of value. That's where gold comes in. The data from precious metals dealers tells us the same story. According to the United States Mint, sales of American Gold Eagle coins to authorized dealers were up 43% year over year in 2025. These are physical coins that Americans are buying to hold in their possession. Retail demand for physical gold, the kind of demand that comes from individuals worried about the financial system, has been accelerating. The refineries that process gold into bars and coins have been running at full capacity. The premiums you pay over spot price to buy physical gold, those premiums have been widening because demand is outstripping the rate at which the supply chain can deliver. When you see both institutional flows through ETFs and retail demand for physical gold rising simultaneously, that's telling you this isn't just one segment of the market. This is broad-based concern about the system. Let me show you one more piece of evidence that proves institutional money is taking this seriously. The options market for gold has seen explosive growth in open interest for calls, the contracts that profit when gold prices rise. According to CME Group data, open interest in gold call options for strikes above $5,000 has increased by over 200% since the Trump versus Cook case was filed. Think about what that means. Sophisticated traders who use options aren't just buying gold at current prices, they're betting real money that gold could be above $5,000 in the next 12 to 18 months. These aren't lottery tickets. These are portfolio hedges being put on by people who manage serious money and need to protect against tail risk scenarios. The $5,000 strike is exactly what Goldman Sachs is modeling him as their Fed independence collapse scenario. Pop quiz: what do central banks, sovereign wealth funds, pension systems, and ultra-high net worth families all have in common right now? They're all increasing their gold allocations at rates we haven't seen in modern times. The Government Pension Investment Fund of Japan, one of the largest pension funds in the world, disclosed in their latest quarterly filing that they've initiated a position in gold for the first time in the fund's history. Norway's sovereign wealth fund, which manages over $1.6 trillion in assets, increased their commodities allocation with a specific overweight to precious metals. These are conservative institutions that move slowly and carefully. When you see them making changes like this in unison, they're responding to something systemic. They're responding to the breakdown of trust in the dollar-based system that has defined global finance for 80 years. The Bank for International Settlements, which serves as the central bank for central banks, published a working paper in late 2025 that should have gotten more attention than it did. The paper analyzed the relationship between central bank independence and currency stability across multiple countries and time periods. Their conclusion? Every time central bank independence is meaningfully compromised, currency depreciation follows within 12 to 24 months. Not sometimes, every time. The mechanism is straightforward. Once markets believe that monetary policy is being made for political rather than economic reasons, they price in higher inflation expectations. Higher inflation expectations lead to currency weakness. Currency weakness leads to capital flight. And capital flight leads to exactly what we're seeing now: institutional money moving into assets that can't be debased by political decisions, assets like gold. Have you looked at your own portfolio recently and thought about what percentage depends on things staying normal? Your stock holdings depend on continued economic growth and corporate profits. Your bond holdings depend on the government making payments and the dollar holding value. Your retirement account probably has some cash allocation that is earning a few percent in a money market fund. All of that is inside the system. All of that depends on our institutions functioning the way they're supposed to function. But what if the Supreme Court rules in Trump's favor this summer? What if Fed governors can now be fired at will? What if the next step is Jerome Powell being removed despite his term not expiring until 2026? Do you really want 100% of your wealth depending on that system remaining intact? That's the calculation that institutional investors have already made. And that's why gold is above $4,300 right now, even before the Supreme Court has ruled. Let's talk about timing. The Supreme Court heard oral arguments on January 21st, 2026. Based on how the court typically operates, we should expect a decision by late June or early July. That gives us roughly 6 months to position before the verdict comes down. But here's what you need to understand about markets. They don't wait for confirmation. They don't wait for the official announcement. Markets move in anticipation of events, not in response to them. By the time the Supreme Court releases its opinion, gold prices will have already adjusted based on what traders expect that opinion to say. The question every investor should be asking right now is, have I positioned my portfolio for what happens next? Or am I waiting until it's too late? Think about the scenarios that play out from here. Scenario 1. The Supreme Court rules in favor of Lisa Cook, deciding that the president cannot fire a Fed governor without cause related to specific legal violations. Trump loses this round. But does that actually restore Fed independence? The damage may already be done. Markets have seen that a president is willing to challenge Fed independence directly. They've seen the Department of Justice investigate Jerome Powell. They've seen political pressure applied to an institution that's supposed to be insulated from politics. Even if Cook wins the case, the precedent of presidential interference has been established. Future presidents now know this is a tool they can attempt to use. According to Goldman Sachs' analysis, even the scenario where Cook prevails doesn't eliminate the risk premium that's been priced into gold. It might slow the rally, but the structural shift has already begun. Scenario 2. The Supreme Court rules in Trump's favor, establishing that the president has authority to remove Fed governors. Lisa Cook is out. Trump appoints a replacement who aligns with his monetary policy preferences. That gives him a 4-3 majority on the Board of Governors. Now, the Federal Open Market Committee has a different balance of power, but it doesn't stop there. Jerome Powell's term as Fed chair expires in May 2026, just weeks before the expected Supreme Court decision. If Trump wins the Cook case, what's to stop him from removing Powell immediately and installing someone more pliable? The Department of Justice has already opened an investigation into Powell's conduct. The groundwork is being laid. Goldman Sachs calls this the constitutional crisis scenario, and it's the one that drives their $5,000 gold forecast. Why? Because if Powell is removed, we enter territory that undermines the entire foundation of dollar credibility. Let me walk you through the mathematical inevitability of what happens next. JP Morgan's baseline forecast has gold reaching $4,000 per ounce by mid-2026. That's below where we are right now, which tells you something important. The market is already ahead of JP Morgan's baseline. We're trading at 4,300 because traders are pricing in more than the baseline scenario. But here's where the math gets interesting. JP Morgan's commodity team calculated that every 100 tons of net new demand for gold lifts prices by approximately 2.4%. Central banks alone are adding over 1,000 tons of demand annually. That's a 10 times multiplier. 1,000 tons divided by 100 equals 10. 10 times 2.4% equals 24%. Price appreciation just from central bank demand, assuming all other factors remain constant. We're at 4,300. Add 24%. That gets you to $5,300 per ounce. But all other factors won't remain constant. That's the point. If Fed independence is compromised, we get a cascade of effects that all point in the same direction. Higher inflation expectations because monetary policy becomes unpredictable. Lower bond prices because investors demand higher yields to compensate for inflation risk. Continued erosion of dollar reserve status as foreign central banks accelerate their diversification out of treasuries. Each of these factors independently drives gold demand higher. When they all occur simultaneously, you get what market analysts call a structural repricing, not a rally that will reverse when conditions normalize. A permanent shift to a higher price level because the underlying fundamentals of the monetary system have changed. Here's what should keep you up at night if you haven't positioned for this. The Federal Reserve has a meeting scheduled for January 28th, 2026. That's next week. Lisa Cook will be in attendance, participating in discussions about interest rate policy and economic projections. But she's doing so under the cloud of a Supreme Court case that could remove her from the board within 6 months. Think about the dynamics in that meeting room. You've got governors who are trying to make sound monetary policy decisions for the good of the economy. But they are also human beings who are watching one of their colleagues potentially be fired for political reasons. How does that affect their decision-making? Do they become more cautious, more inclined to go along with what they think the administration wants? That subtle shift in behavior. That's how independence erodes, even before the formal legal structure changes. The timeline for investors is compressed. We're in late January 2026. The Supreme Court ruling comes in June or July. It's 5 to 6 months. But gold doesn't wait until the ruling is released to move. According to data from previous periods of monetary policy uncertainty, gold typically rallies 3 to 6 months ahead of confirmed policy shifts. Why? Because institutional investors have to move large amounts of capital, and they can't do it all at once without moving the market against themselves. So they start positioning early. They start accumulating gold gradually, spreading their purchases over time to minimize price impact. If you're waiting for the Supreme Court announcement to decide whether to buy gold, you're competing with institutions that started buying months ago. You're buying at the top of the move, not the beginning. Let me give you a specific example of how this plays out in real portfolios. Imagine you're managing a pension fund with $10 billion in assets. Your allocation might be 60% stocks, 30% bonds, 10% alternatives, including some gold. That's fairly typical for a balanced institutional portfolio. Now you're reading the same reports from Goldman Sachs, Bank of America, and JP Morgan that we've been discussing. You're seeing the Fed independence risk. You're seeing central banks buying gold. You're seeing ETF inflows at record levels. You decide you need to increase your gold allocation from 10% to 15%. That's a 5% shift, or $500 million. Can you buy $500 million of gold overnight? Absolutely not. You'd move the market dramatically. So you develop a plan to accumulate that position over 3 to 6 months, buying steadily without creating obvious footprints in the market. That process started months ago for the smart institutional money. By the time the Supreme Court rules, they'll be fully positioned. What about the individual investor, someone like you managing their own retirement account or investment portfolio? You don't have billions of dollars, so you don't have the same problem of moving the market with your purchases, but you do have a different challenge. You need to make the decision to act while there's still time to benefit from the move. Think about your current allocation. If you have 10% of your portfolio in gold or gold-related investments, you're ahead of most Americans. The average retail portfolio has less than 3% in precious metals. But is 10% enough given what we've outlined here? If Goldman Sachs is right about the $5,000 scenario, gold still has another 16% to run from current levels. If you've got 10% of your portfolio in gold and it goes up 16%, that's a 1.6% gain on your total portfolio. Better than nothing, but hardly life-changing. Now, what if you had 25% in gold? That same 16% move becomes a 4% gain on your total portfolio. That's starting to matter. The Federal Reserve's own data shows something remarkable about wealth distribution during periods of monetary instability. According to their survey of consumer finances, households in the top 10% of wealth distribution significantly increased their allocation to alternative assets, including precious metals, during the period from 2020 to 2025. Meanwhile, households in the bottom 50% actually decreased their precious metals holdings. Why does this matter? Because wealth gaps widen during periods of monetary transition. The people who understand what's happening and position accordingly preserve and grow their wealth. The people who don't understand or don't act see their purchasing power erode. This isn't about blaming anyone. This is about recognizing that information asymmetry creates winners and losers, and you have a choice about which side of that divide you want to be on. Let's talk about what happens if we're wrong. What if the Supreme Court rules for Lisa Cook, Trump accepts the decision, and Fed independence is preserved? Gold prices could pull back from current levels. Maybe we come down to 4,000 or even 3,800. Would that be a disaster for someone who bought gold at 4,300? Only if they panic and sell at the bottom? But remember what we discussed earlier. Central banks are buying over 1,000 tons annually. ETF inflows are at record levels. Even in the scenario where Fed independence is preserved for now, the trend toward diversification out of dollar-denominated assets continues. The world has seen that this institution can be challenged, that uncertainty doesn't disappear completely just because one court case goes a certain way. Gold might consolidate, but the long-term trajectory driven by loss of confidence in the dollar system remains intact. Here's the calculation that professional investors are making right now, and you should make it too. What's the upside if the Fed independence risk plays out as Goldman Sachs models it? Gold at $5,000 from $4,300 is 16%. What's the downside if the risk doesn't materialize and gold pulls back? Maybe 10 to 15% in a worst-case scenario where everything goes back to normal. That's an asymmetric bet. The potential upside and downside are roughly similar in percentage terms. But there's a crucial difference. The upside scenario involves a fundamental breakdown in monetary credibility that will affect every dollar-denominated asset you own. The downside scenario involves things staying normal and your other investments doing fine. So gold isn't just a directional bet on prices going up. It's insurance against your other holdings all declining together in a Fed independence crisis. That's why institutional investors are willing to pay current elevated prices for gold. They're not buying it to make a quick profit. They're buying it as a hedge against systemic risk. The next Fed meeting is January 28th. Lisa Cook will be there. The next meeting after that is March 18th, then May 6th, then June 17th. The June meeting happens right around the time the Supreme Court typically releases its most significant decisions before the summer recess. Think about the progression. Every meeting between now and the Supreme Court decision is occurring under the shadow of this case. Every interest rate decision, every policy statement, every press conference with Jerome Powell is being analyzed for signs of political influence or independence being compromised. The markets are watching in real time. Gold is responding in real time. By the time we get to that June or July Supreme Court announcement, months of positioning and repricing will have already occurred. Here's what every investor needs to ask themselves today. Not tomorrow, not after the Supreme Court rules, but today. Have I taken the steps necessary to protect my wealth from a scenario where Fed independence is compromised? Have I allocated enough to assets that don't depend on institutional trust? Have I positioned myself to benefit if gold continues to rise, rather than watching from the sidelines? The institutions that manage billions of dollars have already answered these questions. Central banks have answered these questions by buying record amounts of gold. Pension funds and sovereign wealth funds have answered these questions by increasing their allocations. The smart money has already moved. The question is whether you're going to join them while there's still time, or whether you're going to wait for confirmation that by the time it arrives, you've missed the opportunity to position at reasonable prices. The case of Trump versus Cook isn't just about one Fed governor. It's about the future of American monetary policy. It's about whether the dollar remains the world's reserve currency. It's about whether our institutions can maintain the independence necessary to function properly. And most importantly for your portfolio, it's about whether the assumptions that have underpinned American wealth for the last 80 years still hold true. Gold above $4,300 is telling you that those assumptions are being questioned. $5,000, if we get there, will be confirmation that they've broken completely. The smart money isn't waiting for confirmation. Neither should you.